Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into our YouTube channel for our weekly video analysis. If you like this video, please give us a thumbs up and consider subscribing. So here's what we're going to talk about today. We're going to look at this narrative that suggests that the 10-year yield is responsible for the decline in tech-related stocks, because I don't think that is true, and we're going to look at the evidence to see if it is true. We're going to look at TLT as well because it is hitting a potential bounce zone, but it's still a falling knife out there. And then I've got some leading ETFs that I want to highlight that have long-term uptrends, they have bullish continuation patterns on the charts, and they're making breakouts. Let's hit the charts. So I want to put to rest this notion that the rise in the 10-year Treasury yield is responsible for the decline in high-flying technology-related stocks, because I think that is poppycock to be nice. I think it's more coincidence. And remember, correlation is not the same as causation. And if you look at this chart here, we're going to start off with the 10-year yield to kind of put this move into perspective. So this is a 10-year yield going back to the middle of 2010. And you can see from the middle of 2011 until 2019, it ranged from this 1.4 to 3.3 area, let's say. That was the range. And it went up, and it went down, and it went up. And then, of course, it went down, and then it plunged because of the pandemic. That was in early 2020 when we had the COVID crisis. Stabilized, and then we get this surge. And this surge is being blamed for the decline in a lot of high-flying technology stocks. But look at where the 10-year yield is. It's getting back to the normal part of its prior range, and it's the low end of that range. It's not the high end of the range. It's just getting back to normal, and that's what we all want to do after COVID passes, to get back to our normal lives. So I think this is just a reversion to the mean, and the mean is back here somewhere in this, 1.5% to 3% area. And interest rates, I think, are not my first point of call when I think of technology stocks, especially when the 10-year is below 2%. If we look at TLT here, you can see that it had this big move up, and then there's the big surge after COVID when COVID hit, and then it plunged, and it's coming into a big support potential reversal zone, as you've got this big move up, and then this decline is retraced 1/2 to 2/3, and this is where we could get an oversold bounce, and TLT is definitely very oversold. Now, I'm not a fan of catching falling knives. I think there are better plays out there, and I'll get to those here in a little bit. So the financial news has been all over this issue, suggesting that the decline in tech stocks is directly related to the surge in Treasury yields, and I do not think that is the case. And when you hear something like this, you can go back and you can check it on the charts to see and make that decision for yourself, whether it is true or not. And if I'm going to invest, trade, or whatever in a technology-related stock, the 10-year Treasury yield is not going to be my first point of call as far as making a decision. It's going to be way down the line, if at all. And you can see here, this is a chart, and we've got the 10-year Treasury yield, the black line, and we've got the equal weight NASDAQ 100 ETF, QQEW, is the red line there. And we can see here sometimes when Treasury yields surged, and not only surged, but doubled, and QQQEW went up. And this is a move from like 1.4 to 3 point something percent. And it did this again here from 2016 to 2018. That is a big move, but the equal weight QQQ moved higher as well. And then we can see at the beginning of this move, we had already doubled, and QQEW is moving higher. And it wasn't until this last part of the move that we saw the decline. So I think the correlation between these two is iffy at best. And I think there are better reasons to find as far as why is QQQ or QQQEW correcting. And let's look at that chart next. So we were already seeing some warning signs within QQQ, and I put out this article in Chart Watchers on February 19th. A medium-term breadth indicator waves the caution flag. And then if we look at this updated chart here, what it is the percentage of stocks above the 50-day moving average for the NASDAQ 100. And we can see here, here's the NASDAQ 100 ETF, QQQ. And what we can see is we get less participation. We get this move above 85%, and then we don't get back above 85%. Meanwhile, QQQ moves higher, and then it breaks down. So that gives way to a correction. We can see it happen here in July, August. We can see it again in January, February, and that, of course, was the COVID crash. And then we can see the most recent occurrence was from July to August, early September, when QQQ moved higher, and you can see participation was waning. You got above 85% in July, but you didn't in late August, early September, and then broke down, and that gave way to this corrective period in September, October. And this happened again in January, February. QQQ goes to new highs, as you see here, the blue line, and then you can see the percentage of stocks above the 50-day is above 85% in early January, and then QQQ gets a new high, and that percentage doesn't even get above 75%. So fewer stocks were participating in the advance. That's a warning, and then we got confirmation a few days later with that move below 50%. So now we're in some sort of a corrective mode, and corrections are kind of like a box of chocolates. You never know what you're going to get. You know, you could get this 2-month like trading range, or you could get this short pullback like you had here in 2019. Here's another trading range that unfolded over a couple of months. I would tend to be more inclined to look for some sort of a trading range to digest these gains that we've had. Also, if you look at QQQ, it's a huge advance there. And so it's due for some sort of correction, and corrections are healthy because they digest gains and they set the stage for the next move higher. So over at trendinvestorpro.com on Wednesday, I made some changes to the broad market model that I use to identify bull markets and bear markets. And those changes involve some breadth models that I use. Here's a picture of the 5-200 cross for the S&P 500, and then these 4 breadth models. And we combine these 5 indicators to create what I call a breadth composite model. And there you can see the signals that it's generated over the years. And I lay out the returns. And then I show a way to diversify with 10 ETFs to improve those returns, and then add the Stoke-Close signals to get good returns and reduced drawdowns. So this article is available to subscribers at trendinvestorpro.com. So on Wall Street, they have an old saying that says there is no free lunch, and that's pretty much true for us mere mortals. If you got some serious computing power and some great algorithms, perhaps you can scrape out some free lunch from some price action. But in general, there's no free lunch out there on Wall Street. But the closest you can get to free lunch is having a diversified portfolio. And that means if you're investing, don't have 90% tech stocks, all right? Diversify that portfolio a little bit. If you want to mimic the S&P 500, you could have, say, 25% tech stocks. But you can also choose within the technology sector or a sector that is outperforming. Now, I'm going to take some ETFs here that are showing strength. This is the home construction iShares, and its performance is looking good. Chart structure is looking good. First, we have the full stochastic 125.5 in the indicator window. and it's been bullish since May there when it moved above 60. So it is staying in its bullish range, stays bullish unless it goes below 40 there. And then we look within this uptrend, we had a nice triangle pattern. So this is a consolidation within an uptrend. This is what we're looking for, is a bullish continuation pattern. We had one here in June. That was a really big one because you got a really nice gain. You had another one here in August, September, but you had a breakout and then a move lower. And this is another thing, a pet peeve of mine. I really don't take support breaks seriously in a bigger uptrend. All right, I take them as part of the ebbing and flowing of an uptrend because, even though you technically broke below this low on a closing basis there, you're above the rising 200-day and Stoke close is bullish, so I wouldn't buy into that. But what we're seeing here is a new high, so it's in an uptrend. And then we had this kind of flag-like pullback here, and then the breakout, and we're on the verge of hitting a new high. And look at RSI, it was in that 40 to 50 zone for an oversold setup. Now, I'm also seeing consumer staples perk up this week or so. This is the equal weight consumer staples ETF. And sometimes I like to use these to get an idea of what's happening within the sector as a whole, because XLP, the consumer staples ETF, is dominated by Procter & Gamble, its biggest component. But if we look here, we can see some big consolidations there and breakouts. So there's a breakout, and this is kind of one big consolidation. Perhaps we've got a little falling wedge here and a breakout working. But we're in an uptrend. We're above the rising 200-day. Stoke closes on a bullish signal, and RSI is coming out of its oversold zone. Another one to look at here is materials. Basic materials are showing strength. So this is just an uptrend. And what do we look for when we're in an uptrend? We look for pullbacks within that uptrend. We look for bullish continuation patterns. And so Stoke Close has been bullish since May. And we've got a little triangle there. We've got a bigger consolidation here in September, October. We have a very tight consolidation here. And you missed it. Well, it came back to this support zone to give you a second chance. And now we've got some sort of a breakout again working here for basic materials. And this sector is typically dominated by the big chemical stocks like Dow, or is it Dow DuPont? They merged, I believe. But there's a breakout there, and that is bullish. And lastly, I just want to leave you with a brief update on two stocks I highlighted last week, Mastercard and Visa, and they are part of the technology sector, so they are leading within that sector. There's Mastercard, a big consolidation within an uptrend and breaking out to a new high, so it's clearly a leader. Visa is not quite as strong, but it does have a big consolidation there, and it is breaking out almost to it's at a new high this week. So those two are leading. So if you'd like to know more about trendinvestorpro.com, you can click on the link in the description below. If you like this video, please give us a thumbs up and consider subscribing. Thanks again for tuning in, and I'll talk to you again next week. Have a great day.